Money. We all use it. We all think about it. Some of us have a lot, others, not so much. But what is it really? It's more than just paper or coins. It's an idea, a social agreement. It allows us to trade our work for things we need or want. It acts as a measuring stick for value. It lets us compare the price of a coffee to a car. Pretty useful that. Think about life without money. Imagine trying to get a loaf of bread. You're a fisherman. The baker doesn't want fish today. He wants shoes. So you find a shoemaker. Does he want fish? Maybe. Maybe not. This is called barter. It's messy. It's inefficient. Money solves this problem. It's a universal want. Everyone accepts money because they know others will too. It makes life simpler, much simpler. Money comes in many forms. Long ago it was shells or cattle. Let's rewind. Way back, before banks, before stock markets, before your credit card, people still traded, they bartered. I'll give you 3 chickens for that axe. Sounds simple, but it wasn't. You needed a double coincidence of wants. Both people had to want what the other offered. Right then, right there. Imagine the hassle. Finding that perfect match took time, lots of time, and effort. Then, someone had a bright idea. Let's use something everyone values. Something durable, something divisible. Enter commodity money, shells on the coast, salt in the desert. Eventually metals like gold and silver. These were easier to carry, easier to divide. Governments started minting coins, stamping their authority on them. This standardized things. It built trust. A Roman soldier could get paid in coins. He knew he could spend them anywhere in the empire. That was a big step. Carrying lots of gold was risky, heavy too. So, paper money emerged. Goldsmiths in Europe started issuing receipts for gold deposits. These receipts began to circulate as money. They were promises. I owe you this much gold. Banks grew from this. Let's talk markets, the places where financial dreams are made, and sometimes shattered. First, up stocks. When you buy a stock, you buy a tiny piece of a company. You become a part owner. If the company does well, its stock price might go up. You could sell for a profit. Companies might also pay dividends, a share of their profits. But if the company tanks, so does your stock. It's a gamble. A calculated one, hopefully. Then there are bonds. Think of a bond as an IOU. You lend money to a government or a corporation. They promise to pay you back on a certain date, plus interest, regular payments. Bonds are generally seen as safer than stocks, less drama, more predictable, but usually lower returns. Governments issue bonds to fund public projects, roads, schools, companies issue them to grow their business. It's a way to borrow big money. Enter the new kid cryptocurrencies. Bitcoin, Ethereum, Dogecoin, thousands of them. These are digital currencies secured by cryptography. They operate on a decentralized network called a blockchain. No central bank controls them. Their prices can be incredibly volatile, skyrocketing one day, plummeting the next. Some see them as the future of money, others see a speculative bubble. The jury is still out. Wall Street. It's a street in New York. But it's more than that. It's a symbol. The heart of American capitalism. Home to the New York Stock Exchange. Giant investment banks. Fortunes are won and lost there. Decisions made on Wall Street affect Main Street. They affect the world. It's a place of power, of ambition, and sometimes of spectacular folly. It's where the money game is played at the highest stakes. Banks are the bedrock of the financial system, or so they say. Commercial banks take deposits, they make loans to people, to businesses. This helps the economy tick. Investment banks are different. They help companies raise money by selling stocks or bonds. They advise on mergers and acquisitions, big deals, complex deals. Banks are supposed to be safe, stable. But when they get into trouble, everyone feels it. They are often too big to fail. Then you have hedge funds. These are private investment pools, usually for wealthy individuals and institutions. They use sophisticated strategies, often aggressive, sometimes opaque. They can bet on stocks going up or down. They use leverage, borrowed money to amplify returns or losses. Section 5, the magic of making money, how currency comes to be. Where does money come from? Does a government worker just hit print on a giant machine? Well, sort of. But it's more complicated than that. Central banks are key. In the United States, it's the Federal Reserve, the Fed. In Europe, the European Central Bank. Their job is to manage the nation's currency and its money supply. They aim for stable prices and maximum employment. A tough balancing act. They have powerful tools. Physical money, the notes and coins in your pocket, is indeed printed by government mints and printing bureaus. They design it, make it hard to counterfeit and replace old, worn-out currency. But this physical cash is only a small fraction of the total money supply, a surprisingly small part. Most money today isn't paper, it's digital. It exists as electronic records in computer systems. Section 6. Borrowing and growing, understanding loans and interest's power. Loans. Most of us will take one out at some point. A mortgage for a house, a loan for a car, student loans for education. A loan is borrowed money. You get a lump sum now, you promise to pay it back later. Usually in installments, over a set period, with an extra charge on top. That extra charge is crucial. It's the price of borrowing. It's what makes lending worthwhile for the lender. That extra charge is called interest. It's expressed as a percentage, the interest rate. If you borrow $100 at 5% interest per year, you'll owe $5 in interest after 1 year. Lenders charge interest for several reasons: to cover the risk that you might not pay back, to compensate for inflation, and to make a profit. Interest rates vary, based on risk, based on the central bank's policy, based on how badly you need the money, or how badly they want to lend it. There are two main types of interest: simple interest and compound interest. Simple interest is calculated only on the principal amount. Section 7. The Global Money Maze. How it all fits together. Finance isn't just local, it's global, a vast interconnected network. Countries trade goods and services with each other. This requires exchanging currencies. If an American company buys German cars, it needs euros. If a Chinese firm sells electronics to Brazil, it gets paid in real. This happens in the foreign exchange market, Forex or FX. Trillions of dollars are traded daily. Exchange rates fluctuate constantly, driven by supply and demand, and a whole lot of speculation. Several big institutions try to keep this global system stable, or at least try to manage the chaos. The International Monetary Fund, IMF, the World Bank. They were created after World War II. The IMF provides short-term loans to countries facing financial difficulties. It aims to prevent currency crises. The World Bank focuses on long-term development, funding projects in poorer nations. They have their fans and their fierce critics, accused of imposing harsh conditions. Money flows across borders constantly. This is called capital flow. Companies invest in factories abroad, known as foreign direct investment. Investors buy stocks and bonds in other countries. These flows can bring benefits. Capital can fund growth. Section 8. Tomorrow's treasure peeking into finance's future. The world of finance is changing, fast. Technology is the main driver. Call it fintech, financial technology. Think mobile payments, tapping your phone to buy coffee, robo-advisors, algorithms managing your investments, artificial intelligence making lightning-fast trades, peer-to-peer lending platforms, bypassing traditional banks. These innovations promise more convenience, lower costs, greater access. But they also bring new risks, new challenges for regulators. Then there's decentralized finance. DeFi, it's built on blockchain technology, the same tech behind Bitcoin. DeFi aims to recreate traditional financial services, lending, borrowing, trading, insurance, but without central intermediaries, no banks, no brokers, just code, smart contracts. It's a radical vision. Proponents see a more open, transparent, and efficient financial system. Critics see a Wild West, prone to hacks, scams, and instability. The potential is huge. So are the pitfalls. Even central banks are getting in on the digital act. They are exploring central bank digital currencies, CBCs. These would be digital versions of a country's fiat currency, issued and backed by the central bank, like digital cash, potentially offering faster, cheaper payments, and greater financial inclusion. Section 9. Hidden riches, surprising financial facts, and a final thought. Finance has a long, quirky history, full of strange details. For instance, the word bank itself. It comes from the Italian word banca. This meant a bench or table. Moneylenders in medieval Italy worked from benches in the marketplace. If a lender failed, his bench was broken. Bancarrota, broken bench. That's where we get the word bankrupt, a literal breaking of their business. Quite a dramatic origin for such a common term. Paper money feels ancient to us now, but it was a revolution. The first known use of paper money was in China, during the Tang dynasty around the 7th century, but it became more widespread during the Song dynasty, over 1,000 years ago. These were called flying money promissory notes, easier to carry than heavy coins for large transactions. When Marco Polo visited China in the 13th century, he was astonished by this paper currency. He wrote about it extensively. Europe took centuries longer to adopt it widely. Today, the US dollar is king. It's the world's primary reserve currency. Central banks around the globe hold vast amounts of dollars. International trade is often priced in dollars, but this wasn't always the case. Before the US dollar, the British pound sterling held that dominant position. For much of the 18th and 19th centuries, and before that the Dutch guilder, currencies rise and fall in prominence based on economic power, political stability, and trust. The story of money is a story of shifting power,